Welcome to the breakthrough. Thank you guys for coming out and attending. For those of you who are in person or on live, even on recording, either way, appreciate you guys coming. Glad that you're here to join us for another weekly entrepreneur meetup of the breakthrough. We're good. So here's what we're going to be talking about today. Give you guys a little sneak preview. Anybody here looking to raise money? Anybody looking to become a private lender at some point in time? You already are? So when I started, to me, that was a far off dream. It was a far off dream. I was just a borrower, but I had that thought and that vision, someday I want to be on the lending side of the fence. And so as I've gotten older, I've each year done a little more lending. So today's focus is really going to be teaching lenders how to go about doing their first deal as a private lender. And then to give you guys a little sneak peek, I'm doing a relaunch of Private Lender Playbook at the end of April. Okay, so we're doing a book launch at the end of April, and in that book launch, everyone's familiar with Alex Hormozi, right? And so if you have read any of his books or watched any of his promotions, the way that he's done it, he gives away a lot of free resources and free training with his books, and the video training a lot of times more valuable than the book. And 10% of books actually get read or something. That's crazy. It's crazy. I'm not judging. I got a stack of books I bought and I haven't read yet. It's I was organizing my office this week and I'm all right, these are the books I'm going to read this year. I'm not going to buy any more books until I read these. So that happens. But what I'm doing today is I'm going to double dip a little bit, okay, or just be really, really efficient. So when I start the actual training, I'm actually recording this for some of the training that's going to go to the lenders or whoever buys the book. If there's going to be free resources, if that makes sense. So when I'm recording today, I'm going to be talking to potential private lenders who are, have most likely purchased the book and are going on the resources page and checking out the free content. Now, that being said, for all of you in the room, the first step, man, we got chairs up here if you want, up here, man. The first step to raising private money is yourself becoming as educated as possible. So don't think, I'm going to waste my time. This is for private lenders. Understand everything that a private lender needs to understand. And that's how I learned, just by educating lenders. And that is all I can say that I've really ever done in terms of raising money, is just educate people, answer questions, inform them. They will ultimately make their own decisions, but that's how it all starts. Okay. So we're going to be focused on educating these folks who are interested in private lending. So, and that's what I'm going to encourage you guys to do. Take the slides, what have you, and do the same thing. Let's educate people. So that's going to be the focus, is teaching lenders, hey, here's how you safeguard yourself when you're doing that first deal. The first deal is critical, because if the first deal goes sideways, they're this doesn't work. I'm never going to do it again. But if that deal goes really, really well, now not only do they have a great investment strategy that's one of the best in the world, in my opinion. And now the more that we all do this collectively as real estate investors. So I'll go on a brief tangent. The more that we all do this as collectively as real estate investors, meaning raise money, do it the right way, let people know that this investment strategy is available. That's how changes in marketplace happens. But this is a grassroots effort, right? Wall Street, big banks are not talking about this. Why? They want, how the governments and big companies manipulate the market. They're manipulating crypto. They're manipulating metals right now as we speak. That's what they're doing. They don't want people to know about this. Why? Because it's taking money away from them. They'd much rather someone have $100,000 to $300,000 sitting in a CD versus lending to people like us. So the more that we do it as a whole, people watching this at home, you guys locally, the more it helps us as a grassroots effort. Does that make sense? So that's how this is going to be done, because it's never going to be done on a big organizational structure, except from hard money lending and from some of the mid-tier banks that are getting into this space now. That's how you see some of the loan offerings 9.75%, 9%, all that. The heck is this, right? They're coming into our space, and that's how private money came. First, there were banks, and then there were hard money lenders, low cost of capital, very high in the headache requirements, underwriting, and then you had hard money lenders, right? That was asset based, but very, very expensive. And then private lenders came and filled that gap. So now some of the banks are like, oh, this is a really good opportunity. So they're coming after us. What used to be a blue ocean is slowly turning into a red ocean. Hopefully all that makes sense. Does that make sense? All right, cool. Disclaimer, this is intended for educational information purposes only. Nothing presented should be considered financial, tax, legal, tax, or investment advice. Any actions you guys take based on this information is done at your own risk. Always consult with licensed professionals before making financial or investment decisions. And you can't sue me if you do something dumb. All right, that's the bottom line. Well, you can sue me. People sue for everything. People sue for everything. You know how many lawsuits we get? You know how many lawsuits people threaten us all the time? All the time. My AC is out. It's been 24 hours. AC hasn't come. It's the middle of the summer. I'm gonna call an attorney. Like the stupid, all that. They never do, but it's just like Anyways, I digress. So here's the mission. This is the mission of the breakthrough. It's my personal mission. This is what I'm trying to do here. Is do something that I feel in my heart: motivate, educate, and inspire and equip for each and every one of you to go out and create the life and business that you desire. And I'm leading through example. I'm trying. I haven't done it. Notice that this is an active, right, communication, meaning I'm trying to create the life and the business that I desire. And this is a never ending target. It's not a destination. It's always moving. What I wanted in my 30s when I started looked vastly different than what I wanted in my 40s. Now I'm in my 50s. Okay, now I'm in my 50s. 2 years ago, I was only in my 40s, but now I'm in my 50s. And so what I want today is going to be different than what I want 2 years, 5 years from now. It's continually changing. So I'm committed to like this lifelong pursuit of learning, growing, and helping inspire others for you guys to go out and do it. There's nothing, and I wish he was here. He's not here. Maybe he's coming. I don't know. But there's nothing that excites me more. Nothing excites me more is whenever there's someone I've helped, maybe mentored, coached, guided, whatever, and they go out and do it and they have a success and they have a win. Like whenever we have our own wins, they're fun. We enjoy them, but it's not the same. It's not the same as I go get on my bike versus teaching one of your kids to ride a bike, right? It's just like a whole different thing. And we had a share in the group last night we got really excited about, right, Vivian? With Jose? It was like, dude, like just get goosebumps, man. I was like so proud of that guy, what he's gone through and what he's done and how he's responded. So we're gonna build a community built on truth, ownership, and action. There's not gonna be any BS here. I'm gonna shoot you guys straight. Despite whatever is going on in the economy, the market, I'm not gonna talk it up. If it's not going up, going down, we're gonna be honest with it. There's more opportunity when it's going down. So that's a good thing. A lot of people don't believe that, but I'm just like, you're going to see it. And you may be seeing that very, very soon, because when there's all this uncertainty and all this distress in the marketplace, even if it's not real, a lot of the times it's just hype and they hear it, but they're taking this information, they're affected by it. And people make decisions based on what, Vivian? Emotions, irrational or not. So there's useful emotions or non-useful emotions. So we're gonna utilize the useful emotions, which is our enjoyment, our excitement, but not let that supersede or outweigh numbers and sustainable investing. We're gonna focus on business here, but we're also gonna talk about some life concepts like we did last week. For those of you who attended, we talked about the having it all lifestyle and just create a standard, like stop drifting. Like if you're coming here and you're not taking action, I would say don't come anymore. Go somewhere that you can get plugged into that compels you to take action. This is why I'm involved in masterminds all the time. I'm flying out to Vegas right after this. So when we're done, I got to go hop on a plane to go put myself in an environment to learn and grow and be challenged. So I do everything that I teach you guys to do or talk, suggest that you do. So we want people who are in the arena, people who are doing deals. Eduardo, Paul, Ben, Vivian, Nathan, people are out there doing deals. That's what we want here because we can all help each other grow. So I'm going to go kind of quick on this, but each week, we're going to be based on what I talk about is going to be based on fundamentals, not some concepts, theories I've never done. Based on business, the 5 fundamentals of real estate, based on life, having it all, investing daily in your faith, your family, your fitness, and your finances. There's the man right there. Jose, what's up, my friend? Pretty good. Up there kicking ass, taking names. A little bit about me. Most of you guys in the room know me. So I'm going to skip over this slide if you're online. You can go check me out. But I've done a few things in real estate, and I'm very happy to share the good, the bad, and the ugly. So announcements. Do you guys want to participate for today's presentation? Now, if you have a question, go ahead and ask it. Today's going to be a little bit different for those of you who just came in. I'll explain why in a minute. All that I ask is that your questions be in alignment with what we're talking about, not some abstract thing. If we have time at the end, we'll cover those things. And if we don't, we can push them to another week. We're starting to get some comments online or questions, and I've put one here in the presentation we'll cover at the end of the day if we have some time, because it's relevant to this topic. Check your updates. Last week we didn't have the venue, but I've been assured that we'll be here like clockwork. in person each and every week, no matter what, moving forward. And if you guys have topic requests, fire them away. So before we start the presentation, Aldridge, you want to come up real quick? Eduardo, do you do me a favor? For time.
Okay, hello everybody. If you don't know my name is Jack. I'm the PCF. Also, we had was able to see your last client in, and then also shot a podcast afterwards. Make sure you need access to the process, to the training room, reach out to me. We want to make sure that it's a true partnership that we can.
Thank you. What time is it right now? Oh, happy birthday. That's right. What time? 12:14. 12:14. All right, great. So before I start presentation, I'm going to repeat what I mentioned a minute ago for some of those of you who aren't here. So what month is it? February still? So the end of April, we're relaunching a private lender playbook because second edition. Yeah, so excited about that. I need to hurry up and write it. No, I'm just kidding. Kind of not joking. That's what I'll be working on the plane today. So with that, with the second release of the book, we're creating a video resources page. Very similar to what Alex Ramosi did when he launched like $100 million leads and offers and that kind of thing. He had a video resources page, just a free thing. So we're creating something very, very similar to that for private lenders or for you guys as well. And so it's going to be free content, free training that helps lenders safeguard themselves when they're lending. And like I mentioned earlier, like the 99.9, all that I've ever done to raise money in terms of marketing, so to speak, has just been education. Whether it be one-on-one, whether it be in a group, whether it be a video, whether it be a case study. But in the beginning, it was just one-on-one, meeting people. Hey, are you interested in this? Do you know someone who's interested in it? And just tell them about it. Like, here's how it works. Here's how it's structured. Here's what to look out for. Here's how you look at deals. Just educate and answering questions. So today's presentation is going to be with that focus. So we're recording it, and it's going to be one of the training videos on the resources page. So when I'm recording this, I'm probably going to speak to the lender, like, and people who are watching this in future. So just like that's the context with it. I also have to reread a disclosure statement, but that'll be short and sweet. And at the end, we'll open it up for questions and what have you. All good? All good? All right, well, let's get started. So welcome everybody to the Private Lender First Blueprint training. This is how to underwrite your first deal like a pro. And I want to thank you for purchasing the Private Lender Playbook. And my goal is that you get as much, if not maybe even more value from watching these videos and the resources that we put together here. And this training is the one that kicks it all off, is how to underwrite your first deal like a pro, because it's absolutely critical that your launch into become a private lender is done successfully, because whenever you do this right, and the lenders that I've worked with who have done this right have literally been, utilizing this strategy, not only for years, but I can say for decades now. And they really, really get the benefits of doing it the right way, which is not only the passive side of things, predictable returns when you do it the right way, but just getting out of worrying about what the stock market's doing, the ups, the downs, all that kind of stuff. In today's uncertain world, I think we all want a little predictability and a little bit more certainty in a world of uncertainty. So that's my goal through this quick training, is just give you some things to think about as you're putting together your first deal as a private lender. So that being said, I'm going to do a short disclaimer here and just let you know the information shared during this training is intended for educational and informational purposes only. Nothing presented should be considered financial, legal, tax, or investment advice. Any actions taken based on this information are done at your own risk. That being said, I'm going to share some things with you that will hopefully reduce those risks. I can't tell you completely reduce those risks, because there's always risks in investing, but if you can greatly reduce them, that would be wonderful, and that's what we're going to do here. So let's talk about the truth about your first deal. So your first deal is going to set your future standards. Okay, so essentially what we want to do here with your first deal is establish some really good habits. Okay, establish some good habits, because what can happen is if you do your first few deals and maybe you get lucky, maybe things worked out great, but structurally you didn't have a good foundation, that could prevent some problems in the future. So what we want to do is lay a good foundation for you. And I want to set a framework, like, you're not just lending money. I know, like, you're lending money. Okay, I get that. But what you're really doing here is you're underwriting risk. And like a bank has their underwriting guidelines, you as a lender, you're your own underwriting department, right? So you can underwrite things any way that you see fit. I'm gonna give you some guidelines that you can utilize, and maybe you'll create your own, and that would be fine as well. I also want to say that with your first deal, okay, the goal is not to get the biggest, most maximum return that you can in your money. Your goal here is protection, and doing this in such a way where it's repeatable, scalable, and this can be something that you do for years, if not decades to come, by doing it the right way, by laying this foundation. So your first deal, your asset protection is much more important, in my opinion, than the return on your investment in the beginning. Okay. And there's a saying that I've been saying for years. I don't know where I heard it from, but someone said that you can tell the experience of the borrower. You can tell the experience of the borrower by what they pay for their money, right? An inexperienced investor typically pays a much higher there's a much higher cost for their capital, meaning they utilize hard money lenders and things like that, okay, because of their inexperience. So the reverse could be said as well. Like, you can typically tell the experience of a lender by what they charge for their money. So if you're coming into this inexperienced, I would encourage you to be okay with a lower rate of return in exchange for finding a more experienced borrower, a safer deal, and things like that we're going to talk about. Because right now, like, we want some base hits. Like, we don't need home runs right now. I think I'm stealing from one of my future slides, but that's okay. So the second thing, you need to understand what you're actually doing. Okay, so one of the key rules of investing, this is a Buffett thing and probably other people, is like, don't invest in anything that you don't understand, right? So I'm teaching my kids right now, my kids and my nephews, about investing. That's rule number one. Like, number one, don't invest in something that you don't understand. Even if your best friend or someone that you really, really trust, or you guys, watching this recording, like, I trust you, I'm just going to do it. Brant says, no, you need to understand it first. So understand what you're doing. So private mortgage lending, what is it? It's asset-based. So for this training, obviously we're focused on real estate. That's what it is. It's asset-based. Okay. It's not just a piece of paper. There's an asset attached to it. Our focus obviously is with real estate. There's contractual protection. So a lot of times the way these deals are structured, I say that I've been saying this as well for years, is a lot of our deals that we end up doing with lenders and maybe even partners, they start with a handshake agreement, but they're always protected by the right paperwork and the right contracts. Okay. In this risk managed investing, notice I did say there's risk involved. Okay. I can toot my horn and say that, I've never missed a payment to a lender, 10,000 plus mortgages. It doesn't matter. There's still risk involved in what you're doing. Okay. But your job is to manage that risk. Okay. You want to eliminate as much as possible, but you're still looking at it through that lens. Like, I'm managing risk here. What are you not doing? What are you not acting at? You're not a partner. You're not a partner. In a way, I understand that you are, but you're doing this as a lender. This is not a charity. Like, we're not looking to help other people out. Like, oh, well, let me do them a favor. No, that's not a good framework to be as a lender. You're not gambling, betting on some upside. We're not going to do that. And you're not even acting as a friend. I know that may sound a little bit, wow, but it is my friend. You can be friends, but whenever you're looking at a deal and you're looking at a loan, you have to take that cap off and put on your private lender hat and say, right now I'm focused as a private lender. Okay. And you're making business decisions. And that's what we're doing. You're going to think like a bank, but just don't act like one. One of the things I'm so, over the years, I'm much happier to pay more to my lenders just to avoid some of the headaches of dealing with a bank. This does not mean that we're shortcutting paperwork, guidelines, underwriting, all that kind of stuff. But dealing with the banks, I'd rather bang my head on this nice fancy wall back here at times. And I'd much rather pay my lenders, not a lot more, but a little bit more interest than deal with the bank. So one of the benefits as a borrower working with lenders is that the relationship piece of it, one, is much more rewarding for me to pay a lender than a bank. So there's that piece of it too. And it's just easier and more enjoyable, more rewarding to work with private lenders that I like. And that's to say, most of my private lenders are essentially their friends. So I'd rather work with friends that are easy to work with than with banks. That being said, I've had some lenders that are not so easy to work with. They're more difficult than banks. Like, I'll just go to the bank if I'm going to deal with this. So we're going to be professional, but think like a bank. Just think like a bank. That's it. So number one, before the deal, the deal is very important. But we're going to look at the borrower first. Okay. The borrower, in my opinion, is more important than the property. Okay. What's the percentage? I don't know. Like 51% to 49%. I don't know, but the borrower is the most critical thing, because if that deal goes bad, who's steering that ship? The borrower. And certain borrowers, this is what you're really looking for. Certain borrowers are going to handle adversity much better than other borrowers. So you're looking for someone who has that backbone to navigate things when things go rough. Isn't this right, Jose? This is right. This is what you're looking for. What are you looking for? Experience? Have they done this before? Some of them haven't. Okay. Some borrowers, it's their first time. But remember what I said about you can tell the experience of the borrower but to pay for the money. I will tell you a bad formula is a new borrower, a new investor with a new lender. That's not a good formula. Okay, so in the beginning, eventually you can work towards lending to new investors. Me as a lender, I primarily lend to investors with little to no experience, right? Because I've got a lot of experience and obviously I know how to analyze these things and safeguard myself. But you're looking, these are criteria that you're looking for. And maybe you're gonna, scale them on a 1 to 10. They may be very low at experience, but they're high in some other levels. What's their track record? What's their track record for their investments? Is there some proof there? Can they show references? And track record doesn't just have to be with real estate. I've loaned to other people who are newer to real estate, but they've got a very impressive track record in the business world, in the corporate world, educationally, they're very proven person. I'm pretty sure they're going to be okay navigating a few single family fix and flips and real estate deals, things like that. So you're taking a global picture of their track record. What's their character? Very important. Okay, in character and as well as communication, because there's a lot of communication here back and forth. Are you able to communicate well with them when they talk about their deals, what they're seeking? Is it easy to understand? Do they have clarity on their business plan? So those things should go together. What's their financial strength? Liquidity. Okay, so those are some things you want to ask. You're going to ask for some financials. It's not a make or break thing. Like we're going to talk about how the deal also integrates with this. But that is a piece of the pie that you're going to look at. What's a reputation in the community? Okay, if you're typically private lending is backyard investing, essentially, right? You've got Main Street, you've got Wall Street, but typically most lenders are lending to people in their own backyard. These may be people that you've met at, real estate functions, at, school events. I've met lenders and borrowers at like school events, sporting events, church events. Like, what's the reputation? And this is really important, and it's not always easy to find out someone's reputation. It's a little bit easier now online. Okay, there's people, it saddens me to say this, but there's people in our community right now, okay, that are in the investing world that are actively raising money. But if you do a quick little Google search, you could see they also have class action lawsuits against them for how they've wronged investors. So that low-hanging fruit isn't always there. But do a little digging, go on social media, look for people, ask around, ask for references, analyze that borrower and what's their leverage position on this deal. Are they asking for 100% financing? They're asking for 50% financing. You got to take all of these. There's pieces of the pie when you're analyzing a borrower. So these are things that you're going to look at. You're not underwriting the dude. You're not underwriting the dude. Oh, there's a typo here. You are underwriting the dude, not the deal. Okay, so you're looking at the person, not the deal yet. We're going to look at we're going to look at the deal next, but you're looking at this person right now is what you're doing. And if it's a no here, most likely you don't need to move forward. Okay. If it is a no here, if they don't meet your underwriting guidelines, meaning you don't get that good check, there's some red flags, hit the pause button. It's okay. There's more deals. And you would just say, hey, just professionally, like, this isn't going to be a good fit for me. Thanks, but no thanks. And end it. But if they meet your criteria here, let's look at analyzing the deal now. Okay. So for your first deal, I recommend ultra conservative underwriting. We're always going to recommend conservative underwriting, but we're going to go ultra here. All right. We're going to go ultra conservative underwriting with your focus on what? The purchase price, obviously, that property compared to that specific market. So you're going to have to learn how to analyze these deals a little bit, because sometimes people try to, hopefully not intentionally, but sometimes naively, sometimes they're rational exuberance. They'll put in comps and comparables that don't really belong with that particular property. Okay, so we're looking for really, really niche comps. The ARV, which is after repair value, supported by those comps, not hopes. And one way that I can say this is a lot of times I get presented a lot of deals and they're including an outlier with the deal, meaning one comp does not give me what I need to move forward on a deal. I want to see multiple transactions, multiple closings recently that help me really solidify my value. So we're going to really support those comps. Loan to value, through the book, you'll see, a formula that I recommend. So make sure that you pay attention in the book. but lower is always safer. Okay, lower is always safer. If you are lending with a guideline that's too low, you're probably not going to get a lot of lending business. So, but lower is safer. So the guideline here is lend at an amount that you're comfortable with. Okay, and you get to determine that, and you want to make sure that this borrower has a clear exit strategy. But what is preferable is multiple exit strategies. And what I will say to that is sometimes I've been proposed with certain deals. An investor, usually it's a newer investor. And there's, I'm like, hey, what are you going to do with the deal? I'm like, I don't know. We're going to flip it. Maybe we're going to rent it. We're thinking about Airbnb. We're not really, basically, they're not really sure. I'm looking for clarity and certainty. Okay. I'm looking for certainty. Certainty is essentially power, right? That is moving them in the right direction. Uncertainty, it's the opposite of that. So what is ideal for me is an investor that has a clear exit strategy. This is the focus. This is the game plan. But their investment model is such that they have multiple exit strategies in case things don't work out. And so quickly, what I would share on that is, my single family investment business has been built on medium price housing and below. So in the Houston market, say $300,000 and below, because with those deals, let's say it doesn't flip or we go over budget or the market turns, that's okay because we could rent them, we can owner finance them, we could do an Airbnb, we could do a pad split like I mentioned earlier before we started recording this. So we want to have a clear exit strategy, but also, hey, what are options for this property in case plan A doesn't work out? Do we have a plan B or possibly even a plan C? That's more ideal because it gives you options. Okay. And timeline realism. A lot of borrowers are very excited about their deals and possibly, tainted a little bit by their excitement and their exuberance. So let's look at a realistic timeline. If average days on the market in that particular neighborhood that you're lending on is 6 months and they're predicting they're going to sell it in 30 days, let's take a step back from that. Okay. Let's take a step back from that and put some realistic timelines on it. And budget accuracy. There's a big difference in someone saying, hey, our budget's $50,000. And there's a difference. Someone says our budget is dollars. We're going to spend 20 on foundation, 15 on roof and whatever, 25 on miscellaneous things versus someone that says, here's a line itemized scope of work with exactly what we're doing and the contractors that we're using. Okay. So we want to have good numbers and good data so we can analyze the deal. And then lastly, when you're analyzing the deal, you got to ask yourself this: if I had to own this property, how would I feel? Okay. How would I feel if I had to own this property? If you had to take it back, because that is a reality that sometimes happens. So one of my underwriting guidelines is I won't lend on any property if I wouldn't do the deal myself. It could be a really good return for me as a lender. It could look really great, but I'm like, if I have to take this property back, if I'm not excited about taking that deal back, I wouldn't be excited about if something goes wrong with somebody, but meaning like I would feel good having that asset in my portfolio, then I'll move forward. If I'm a no to that, I'm just a no. It could be a great deal. There's been deals I've said no to that have been absolute home runs for people. And I'm glad for them, but it still wasn't a fit for me, if that makes sense. You have your guidelines, you have your guardrails, and you hold true to those. So after you've analyzed the borrower and after you've analyzed the deal, the next thing you're going to start doing is building your team before the closing, before you fund. So what does that look like? So you never want to do your first deal alone. What's the team that you're going to need? A real estate attorney, a good title company that you can trust, an insurance agent who understands lenders and investments so you can ask them questions because the insurance piece can be a little bit confusing. I would recommend that you talk to your CPA before you invest as well, because a lot of people say, oh, I'm going to make 8%, 10%, 12%. That's great. But this is taxable income. Perhaps if you're doing it through a self-directed or IRA, not so much now, but talk to your CPA for your situation. Get some information on that to make sure that you're moving forward the right way. Because maybe it's preferential that you do this in an IRA. There's some decisions here that you need to make. And then find an experienced investor or lender that you can call. Someone who's done this before, someone with a track record, someone with experience. This is really important. Someone that you can pick up a phone and call. And by the way, we do consulting for private lenders, usually private lenders that are on their first deal. So consider me a resource. You can find my contact information on this page. And we also have some transaction coordination services that can help handle a lot of the paperwork for you and your borrower. And this would be a service that your borrower pays for in my recommendation, but that way you can safeguard your lending with someone who's done this before. Okay. So the takeaway here is your first deal, you should feel supervised. You should not feel like you're going on this on your own. You are being supervised by a team, not just one person, not just two people, maybe 4, 5, 6 people who've been through this process before that are supervising you to make sure you're doing it the right way. Does this mean they're going to supervise you on every transaction? No, but they're going to continue to help you for years and years to come. One of my real estate attorneys has been working with for 16, 17 years now. He's eyes and ears for me. Our title company, eyes and ears for us, et cetera, insurance agent. So you're going to build your team on your first deal, and this team is going to, grow with you as you grow your investing business. So let's break it down real quick. First deal 101, for your first deal, lower leverage. We're not looking for where the investor is seeking high leverage. This is a low leverage type of deal, shorter term. So for us on single family investing, the way that we structure ours is typically 12 months. I know some lenders are seeking 6 months. I don't do that as a lender because I know things happen. I'll give you a really good case in point here in the Houston area. Years ago, we were flipping about 15 houses at the time, and Hurricane Harvey hit. All right. So if we had structured all those for 6 months in the midst of Hurricane Harvey, that would have been a really, really difficult situation. So now we're having to extend loans, go through refinance, do all this kind of stuff. So my practice is that we typically set up a single family loan for 1 year, knowing full well that, a lot of those loans are going to pay out, some in as short as 3 or 4 months, six to 7 months on average in today's market. But we typically set them up for a year. And I'm calling a year for this training a shorter term, meaning it's not 2, 3, 4, 5 years. Okay. You can do that as well. Build some guidelines on there. Maybe rather than just doing a blanket 5-year, you set up 1 annual extensions. Okay. There's ways that you can structure that. For your first deal, you're looking for a stronger borrower experience, the real estate experience, maybe a professional experience, their liquidity, their cash position, things like that. A cleaner property, meaning, there's just gut job rehabs. There's some really gnarly rehabs. There's new construction, all that kind of stuff. The more construction that is involved, that essentially equates to higher risk. So what are we looking for? Lipstick, right? Make readies, paint, carpet, quick turn kind of deals, much, much cleaner type of properties for your first deal in the beginning. And obviously multiple exit strategies like we mentioned. And right here, this is what I mentioned earlier. You don't need a home run. You just need a clean base hit. Just get on base. Just get on base. You don't need to hit home runs every single deal. Hit enough base hits, you go to the Hall of Fame. All right. So here's what new lenders get wrong. Okay, here's what new lenders get wrong. Like I mentioned, you don't need to hit a home run. So they're chasing rate instead of safety. Okay, like we all have what I call a greed gland, right? Like we all want to make more money, but not at the expense of losing money or doing a bad deal, et cetera, et cetera. So don't chase that rate and jeopardize your safety. There may be an opportunity where you get a really high rate and you're still safe. Go for it. But don't let that chase of a high rate outweigh the safety. You trust too quickly. I will tell you this. There are a lot of smooth talkers in the real estate world. Okay. There's a lot of smooth talkers out there, and they're really good at establishing trust. Don't safeguard yourself. Go slow. If you're moving too quick as a lender, some deals are moving too quick. Sometimes you just got to hit the pause button and you know what? It's better to say no than say yes and regret it later. Don't skip over document review. It can be overwhelming. I know this. There's a lot of documents. There's a lot of things to review and check. Your team is going to help you on a lot of this, okay? But some of the key important things, you do need to spend some time to get familiar with the documentation. This is going to take more of your time in the beginning. And with all things, the more experience you have and the more knowledge you have, it will speed up. But in the beginning, expect it to take some time. Don't fund too much on your first deal, and don't do too many. I've seen that too, where a lender gets excited. They read my book, they go to some seminar, and they're like, man, this is the greatest thing ever. And investing wise, I think it's really great. Start slow. Do 1 deal, take it, assess it. What was working? What wasn't working? And then as you grow, then you could do 2, 3 multiple loans at a time. But in the beginning, let's take a slower approach. And lending based on relationship alone is a big, big no-no. Once again, you're not a friend in the situation. You're thinking like a banker. So I'm seeing this happen. So, too many times. So we're not going to do that. So your confidence is going to come from your structure. Your confidence is going to come from your structure and not making these mistakes. Okay. So the conservative structure means your protection is in first position. Okay. First lien position. Can you invest in junior liens, subordinate liens? Yes, but not in the beginning, and only with some heavy investment into your education before you do anything else besides a first lien position. My recommendation is just stick with the first lien position, and you'll be, in a much better position. You're going to have the proper documents, the deed of trust recorded. I understand some of you guys may not be in Texas. There's different legalities in terms of, are you in a mortgage state or deed of trust state? Texas is a deed of trust state, but make sure that you have the proper documentation, title insurance, borrower hazard insurance, naming you as a mortgagee, personal guarantee. This is something that all investors don't offer. Okay. So for years and years and years, offered a personal guarantee because it seemed like the right thing to do. And all that meant was like, hey, if I don't perform on this loan, even though that loan is in my LLC, I was signing over a document saying that you can come after me, pursue and sue me legally, and I will make right whatever capital that you're losing in this deal. And I'm agreeing to it. Like, you can do that. Meaning I am not going to utilize my LLC to protect me. Okay. And quick conversation. I was meeting with an investor one time, and we were just, at a workshop and talking shop and things like this. And this person did a lot more transactions than me. And this topic came up, and he educates a lot of private lenders. And he was like, I don't offer a personal guarantee. And I was like, why is that? And he kind of said it was just kind of cocky, He's like, why should I? He's like, why should I? I've been doing this all these years. I've never defaulted. I'm giving them, they're investing a loan with equity in it. They're going to get the property back if anything happens to me. Like, why should I? And I thought about that for a little bit. And he kind of said it like in a cocky way, but those are actually really valid points. And I sat on that for a while, and actually had a couple of conversations with my lenders. And, one of my lenders said, Brant, like, it's one of the things like that you don't have to do, and we would still invest with you, but it's one of those things that just makes us feel good. So me as a borrower, it's one of those things that we can do to over deliver. And as a lender, I think it's something that you should be seeking, is that personal guarantee. So, okay, interest reserves or structured payments. Like, how is this borrower going to pay you back? Okay, so finding out what is their cash position, what is their liquidity? Do they have the reserves to even pay the loans? Do they have a month of reserves, 6 months, a year? What does that look like? Is there accrued interest? There's things like that. So make sure that you're clear. You're very clear on that payment structure of the loan that you're doing, because there are accrued interest loans. We do a lot of them. Like, we do a lot of accrued interest loans. There's different structures. So make sure that you're clear and this meets or exceeds what you're expecting. Make sure there's a clear maturity date, whether on when the loan is due, when there's an extension due, things like that. Make sure that's crystal clear for you and that it works for your timeline. And don't paint yourself into a corner. Don't paint yourself into a corner. I ran into this recently with one of my private lenders. He was newer. We set up I think it was a 3-year loan, and he was calling me 6 months later saying, I need my capital back. Does that present a problem for me? A little bit. It's a little bit of a headache. We got through it. We're getting this capital back. But don't promise and don't agree to maturity dates if you're not okay with that. If there's something on your horizon that could cause you to need that capital back sooner, don't do that. So let your word be your word and be your bond. So just be thinking about that with that maturity date. But the overall principle here is that your protection and making sure these things are in order is more important than just getting a deal done, because you're going to feel some pressure from a borrower. Like, I need to get this done. It's okay to hit the pause button and make sure that you have everything the way that you need it done. So pre-funding checklist. So this is the short list, but in the resources page, there is a comprehensive checklist. So I encourage you to get that checklist and go through all those items, make sure that you have everything that you need before you fund. But you're going to make sure that your final loan documents are reviewed. The title commitment is clean. I have more details on this on the private funding, the pre-funding checklist. It goes into what to look for in a title commitment, things like what's understanding Schedule B and things like that. Making sure the insurance policy is active, right, before closing. You've reviewed the closing statement, all the loan documents, for that being said, and that the funds are wired to the title company, never to the borrower directly. I'll put a small asterisk. There's a small percentage of times where lenders do wire to us directly. Those are typically if it's like an attorney office closing, sometimes on existing loan modifications. But for the purpose of this training, you're lending to a real estate to buy a piece of real estate that they've never owned before. That needs to go through a title company. Everything needs to be done above board. The wiring and the funding needs to go through the title company. You're not wiring this money directly to the borrower. That is a huge red flag. I'm not going to tell you there's a few exceptions to that rule, but there's very few. So I would tread lightly in that situation and be talking to your team before you ever lend funds directly to a borrower. Like I said, there's a few exceptions, but there's very few. And then make sure there's a clear communication of your draw schedule if there's a rehab involved. Meaning, if you're lending, $100,000 to buy a home and $1 to fund the repairs? Are you lending that entire 50,000 up front at closing? Is there a, draw schedule based on 10,000, 20,000, whatever it is? Make sure it's clearly communicated and documented. Okay, there's got to be clear communication and documentation of that draw schedule. So the final thoughts here is your first deal should not be aggressive. It should include the components that we talked about, but in summary, like the big macro view, a conservative deal, trustworthy borrower, clear, understandable structure. You need to understand this with the proper documentation, and you need to feel good. Okay, you need to feel good about what you're doing. I typically say, becoming emotional in investing is not, we don't want to be led by our emotions. Like, we want the numbers and the documentation to base our decisions on. But at the same time, there's this feel good component about investing. Okay. And I always say, like, whenever I first learned about private lending and what it has helped me to realize my dreams and transform my business, right? And on a small scale, transform certain parts of the greater Houston and Texas area. And I feel good about that. And me as a borrower, like, I feel good about helping private lenders, secure investments with passivity, right? Not fluctuating by the stock market, having predictable monthly payments, all those types of things. And so you too should feel good about what you're doing. Like, when you're investing with the right people in their business, rather than sending your money off to Wall Street or any of these other places where you don't really know and you don't have transparency what's going on. Like, when you're doing lending the right way, you should feel good about it also at the end of the day. And to me, that's that's a small piece, but it's a very important piece, because if you're making money and you know what your investments are doing, like, you're getting that predictability from your investment, so you're able to sleep good at night. But there's that component, like, you just feel good at night because that money's going to do what? Buy some of these distressed properties, renovating them up, providing clean, functional housing for other people. So you should feel good about it. And if you're just making money, in my opinion, that's never really going to satisfy. But if you're making money and enjoying what you're doing, and you're helping others, you're helping communities, indirectly, although directly through your investments, then that's what's going to lead to repeatable and sustainable private lending. So that, my friends, is the first deal blueprint. I hope that you got value from that. I encourage you to go through some of the other training and resources that we have here with the Private Lender Playbook resources page. And thank you very much for your help and support. Boom. Thank you all. So what's our time? How are we on time? All right. Boom. Almost done on time. I'm not going to be able to hang out and talk too much today because I got no autographs today. But so what I did there, that's just what I mean, it's a little bit more fancier presentation or whatever. Thanks, man.
Guys, raise enough money, you too one day will have your face on a giant billboard like this.
Only to have it ripped off and thrown in a janitor's closet. But that's what I've been doing for years. Like, honestly and truly, that's what I've been doing for years. Is just you don't just talk about the upside. Like, whenever we did our first syndication on a land deal, we had to do what's called a PPM, a private placement memorandum. If y'all have ever read those, I talked about these a couple weeks ago. There's all these disclosures about all these bad things that can happen. And it kind of like, you don't want to tell people all this stuff. Like, man, if I tell these people all this bad stuff that can happen, they're not going to want to invest with me. Is that true? But most of them, what happens is they trust you more. It's just true, because you're being honest. Because if you're only painting like the good side, this is all like, and I'm not telling you there's going to be some that aren't going to just go for it, because a lot of them will. It got brought up on the call last night, like, hey, if I'm an inexperienced investor, if I have an inexperienced lender that wants to loan to me, why can't I do that? No, you can do that. You can, because there's sheep that will follow the shepherd. And like, I've kind of joked about this, but I'm not joking. Like, one of my trainings, I'm a private money shepherd, right? And that's kind of what we're doing. Like, we're shepherding our sheep in a good way. And part of shepherding is like, this is what, this is what can happen when everything goes great. But this is all the stuff too that can happen when things don't go great. If things don't go this way, this is what I would do in that situation. Jose was going through something, if you don't mind me pointing it out, like, it was a difficult situation, but my man freaking stepped up, fought like a warrior. And this man has like integrity and resolve like nobody else. So I'm telling you, like, this quote unquote bad deal is going to serve him for life, because whenever lenders, he's looking at future developments, new construction. What about this and that? Let me tell you all about it. It really sucks bad, but here's what I've done. It's so much power to that. It's so much power to that. Yeah. And look at all the great, business people, entrepreneurs, like most of the people that we read who write the books, like most of them have had things go wrong. They all have. It's just a matter of how they handle those things. So for me, it's like, if I can disclose all this stuff and help them and they still want to invest with me, I think we're good. Right. And if they don't, if it scares them off, guess what? That's good too. Because I've had a couple of people, especially in the beginning, people have different risk thresholds. And I had some people, I'm like, this is not a good fit. This is just not a good fit. I'm like, and that's okay. Yeah, that's okay. So we had a question come in. So people are sending questions. We're going to do our best to get to these. So he said, so this is Money Made Easy. I saw you're teaching private lending structure. Not many people understand capital from that side. Quick question. When an operator is strong, but just short on reserves or liquidity, do you typically send them elsewhere or do you just pass on the deal? Man, so this is one of the things for me, but it's different for each lender, is like we just take everything. We took everything in view. Okay, we take everything in view. There's a seesaw of the deal and the borrower. Okay, the deal and the borrower. And it sounds so simple, but it is. It's like it's got to be a win-win or no deal. So certain lenders can be absolutely no. If this person is very, very weak on liquidity, okay, they're going to be weak on liquidity. And be honest, like those are going to be your more experienced investors, your lenders, they're going to be a no. So if you as a borrower, you have to do two things. One, work on improving your liquidity. People say, I have bad credit. Okay, that's okay. You can start from that place, but work on fixing that. But there's always, this is the thing is that there's always people out there. There's always people out there that we talked about last night, right? Like they're just not even going to do the research or whatever. So that money's out there. You just have to decide if your liquidity is in a place where it's not good and that there's a good chance that this deal could go sideways. You got to have the discipline at times just to say no to the deal, or rather than doing this deal solo, you are bringing on someone more as a partner rather than a lender. So there's always ways to navigate through these things. We just got to figure out how to navigate through them. So this is the first announcement of this. You don't have to sign up or anything right now, but you do have to sign up if you want to attend this. I think don't quote me, but I think it's like $20 or something like that. It's gonna be food, drinks, and a copy of the book that will be released that night of the event. So if those of you guys want to come on out. We're going to do our best to get a lot of private lenders in the room. Nate Hare from Directed IRA is going to be coming here. I believe that Close Title and Aldridge Jack is going to help sponsor this event. So that's coming up at the end of April. There'll be a lot of promotion coming out on this. And this, I know you will. So this is a coming soon with my own lending business. We're rebranding it. So we're going to be working on this next month. I am looking for some help on this. I'm looking for an administrative type of person that wants to help me grow this company. And there's going to be some opportunities with this company to grow my lending business. And yeah, so if y'all know anyone who's interested in kind of a work from home opportunity, hit me up because I'd love to talk to them. And lastly, we'll wrap up here. We're out of time, but this is my call to action for those of you here at home and you're ready to launch, you're ready to grow, you're ready to build your business. Either that, you're looking to begin investing or take your investing to the next level. Maybe you're a real estate agent and you're interested in joining our Wolfpack team and you're just looking to grow. You're stuck, like I need a place, a community, an environment where I can grow and launch what I really want to create. Hit me up, scan the QR code. We'll schedule a call and we'll see what we can do to get you going in the right direction, launch your business. That is all we have, my friends. I'm about to hop on a flight to Vegas and I enjoyed it. I'll be back next week. We are locked in for the location for the live event. It ain't going to kick us out anymore like it did last week, and that's okay. We're all going to be good. Go ahead. You have a question? One question.
Good deals and trustworthy people. Money is attracted to good charity. The other thing is, I would say real quick is that, you taught me that you only need a few, you don't need a whole abundance of lenders. Just few, yes. And so, because that problem of you had tons of lenders, but you don't have that many deals, how would you manage that money out there? So that just came to my mind today.
Yeah, it's the rule of one, Gary Keller. Rule of one, start with one. You over deliver, you take care of them, you on your communication, pay your payments early, you safeguard every single thing, and you just focus on one in the beginning. And this is applies to many things in life. If you take care of that one, they're going to multiply. they're going to multiply. But if you go trying to raise all this money from all these people and you don't have structures and systems in place, it can all tumble really, really quick. Yeah. All right, guys. Thank you, guys.